Welcome back to Switzer on Sky News Money. Following the avalanche of phone calls last week and emails on the government's proposed superannuation changes, I've recruited my Switzer Super Report colleague Paul Rickard to join me to answer any of your questions. So if you have any questions, call us on 1300 30 34 35 or send an email to yourmoney@skynews.com.au. All right, Paul, let's kick off. How are you?
Good, thank you, Peter.
I should have welcomed you to the program.
Yeah, thanks for making
You know how rude I can be when it comes to you. All right, let's have a look. You've got a chart here actually showing what would happen if you've got $2 million in your super fund under the Liberal proposals and the Labor proposals.
Yeah, it's worthwhile just working through this, Peter, because we had a lot of calls about the 1.6 and so on, but also just to compare the two proposals. So this is to do with if someone had $2 million in the pension phase. Yeah. Left-hand side, we've got the Liberal policy and the right-hand side on the Labor side. So on the Liberal side, as we know, the first $1.6 million will continue to be tax-free. Yeah. And then the $400,000 potentially you can roll back into an accumulation account, and the earnings on that would be taxed at 15%. Now, if we assume an earnings rate of 6% per annum, that means you earn 6% on the $400,000. That's $24,000 a year. Yeah. The tax on that is 15%, so you'd pay $3,600 in tax. Yeah. The Labor Party's policy, which was announced about 18 months ago, is that the first $75,000 of earnings are tax-free, and thereafter everything's taxed at 15%. So just go through the same example: $2 million in the pension phase and super. The earnings on that at 6% on the $2 million would be $120,000 a year. The first $75,000 is tax-free, so that means you're going to pay tax on the $45,000. And at 15 cents in the dollar, that means a total tax bill of $6,750. Yeah. So on that analysis, someone with $2 million in supporting a pension would be worse off with the Labor policy than they would be with the coalition policy. Okay, so if a person with $2 million in pension mode, in a pension, a superannuation, would probably, if they want to pick a party on money terms alone, the coalition one, even though you might not like it, is softer than the Labor one. Well, it is. I mean, I agree there's an element of retrospectivity, and I think that's what people are really annoyed about. Yeah. But my caution on this is be careful what you ask for, because if it goes to the other side, well, you actually could be worse off. Now, just one other point to make there, Peter. The critical assumption there is the earnings rate. That's 6%. Now, I don't think 6% is particularly high. No, a lot of people shoot for 6%. But if you're going to go and stick your money all into a term deposit or in cash, you might only get 2%. But superannuation fund returns over the last 10 years, median fund is well over 6%. Over 20 years, it's higher. There's a fair figure. I think that's a reasonable number to stick at. So I think it's worthwhile because it sets out both the current policy but also shows what the opposition is articulating. Okay, I think the biggest... You think the biggest problem is the fact that they've lowered the caps for everyone from 35 and 30 down to 25. Tell us why you think that's so bad. Well, I think that's bad for everyone in the long term because, the caps at one stage were $100,000, went down to 50. Now we've got down to 25,000. So, look, for someone trying to put in money into super over many years, remember that for a lot of people, they don't really... A lot of their income comes when they're sort of 50 plus, not when they're in their 20s or their 30s, because incomes go up typically as people get older and they move up in terms of the skill ladder, both in their employment. And in many cases, they're not putting money into super till they're mid to late 50s. Now, $25,000 a year, down from $35,000 at the moment, which it is for someone over 50, I think that's too little. I think that's what people should be really upset about. Yeah, and I think, okay, I agree with that because over the long term, people won't be. No, I think I calculated someone in their 30s will probably miss out putting about 200 grand in if they were really very big superannuation savers. But I worry about this 500,000, which has been called retrospective. And in the purest terms, it's not. But they've changed the rules such that if this was of budget night and people going forward could have 500,000 in, I think it would be a much fairer and there would be less complaints about it. And I've had so many people email us and ask questions about it. And so if I've got a small business and I want to
sell my small business and roll the money in. I have to be married to get $1 million in, so it's good for marriage. But if I haven't got
all these super changes are good for having a spouse. So that's really the best strategy.
For relationships,
is to make sure you have a spouse and you can split it. But you're right, Peter. It's fair to those people already who had money in super, but it's not fair to those who didn't have money in super. So this is, I think, the issue. And you go to that example. Let's say someone's been running their own small business, hasn't put much money into super because all their savings have been going into building their business. Now comes and turns around and sells their business or exits, and they can't get the same money into super that they could have prior to budget night. And in many cases, that's what people do when they turn 50 or get into their 60s.
Well, let's talk about this first. Imagine he's an individual. He sells his business for $1 million. He was hoping to put $1 million in over a progressive number of years. He could have put $180,000 in one go, or $540,000. He used the bring forward rule, and then he could have put the resting over another 3 years. But in the current situation, this person can get $500,000 in, and the other $500,000 will have to be invested outside of super, right?
Yeah.
It's a non-concessional contribution.
They'll still be able to access the small business cap. There's still another 500 from which still applies.
What's your important point?
So there is the CGT concession for small business still exists, but even so, notwithstanding that, previously they could have put $180,000 in, say, for 10 years, $1.8 million. Now they're limited to $500,000, and that's what it really hurts. So that's the inequity of it. So that if somebody had taken action before the budget, they're okay. If they hadn't taken action, tough luck, and that's what the government's saying. Yeah,
we also got another email from someone who said that they were in retirement mode, but they were still earning money and they had other money coming with non-concessional type contributions. They'd actually drawn their superannuation down to zero on the basis they could put $180,000 in a year, and now their non-concessional cap, 500, has been blown. They're not working, so they've got zero in super. This is an example of individual inequity, even if you want to argue that the overall policy is equitable.
Yeah, I mean, there clearly are going to be some cases like that and some, I think, so-called hardship cases. Maybe they'll look at them separately and provide a bit of transitional relief. But at the moment, I mean, look, I actually don't think the package is as bad as it looks, but as we've talked about last week, there are positives and negatives, but there's clearly some cases of inequity, and I don't know how, maybe the government's got to listen to its. I'm sure the feedback is coming to it through its backbench. It's ringing in sort of places like our shop. I can guarantee Liberal held and National Party seats, National Party senators, I'd be lobbying some of those people. Yeah,
well, the thing is we've seen a number of really well-known politicians who clearly don't understand the policy. Now, I understand because it's quite complicated, but this is, imagine the normal people out there as well. They can't understand it and they can see their wealth is being challenged.
Yeah, and, as we've talked about, this is going to be good for the property market longer term. Now, whether the government means it to be good for the property market, I think they've listened to Treasury, and, we all know that a lot of the public servants in Canberra do live in the world of their own. They have their own very generous super scheme, 15.4% if you're a public servant. I think it's come a bit out of Treasury. It looks like they almost picked up a package that Treasury wrote, didn't think about it too much, and are now saying, well, we've got to win an election. We can't undo it, but my guess is if there's enough screams, there'll be a little bit of undoing after the election. Yeah,
well, and I think that 500,000 is the one they should change. Now, we've got a caller on the line. It's Alan. How are you, Alan?
Yeah, good, thanks, Peter. My question is that I worked overseas up till about 2010, and I saved up 500,000. I wasn't in super previously to that, so I came back and I put the 500,000 in 2010, and over the intervening years I've accumulated 549 as non-concessional contributions. Now, since then, I've actually saved up some more money. I've got about 170,000, which I was planning this year to put into superannuation, but I didn't. I'm just wondering what you would recommend what I do with that money. Should I hold on and wait till the government makes up its mind, or should I just go and invest it somewhere else? Thank you very much.
Alan, I think I would hold off. I mean, you're already over the limit, 549,000. You'll be able to keep the extra 49,000. That's the only good news. But the other 100,000 or so, I wouldn't do anything with it in the short term. Look, if you see the right investment, invest it outside super, but if you don't, I wouldn't put it in your super fund because the chance, I think there may be some relief still, but at the moment, there's going to be a penalty tax, an excess to be arranged, but that'll cost you.
Yeah. Now, if Labor wins, well, he can put the non-concessional caps are still good, aren't they?
Well, you never know. I mean,
no, but at this point in time, they have not adjusted. No. So basically, he can slam his money in. If Bill Shilton gets in on the Monday after the election, Alan, go for it. Get that money in before they can change the rules.
Peter's just a risk taker. I'm trying to be the prudent, responsible person.
All right. Now, another point, I guess we should make the point is that, with that money, that the money's outside of super, if the coalition wins, this is a question that someone asked me the other day. Will the first 18,000 or so be tax-free outside of super?
Yeah, I mean, there's no change to the so-called tax-free limit. This is what people forget. Sometimes there are, particularly with people who've got low balances, better investments outside super. So the first $18,200 is tax-free. So that means if you're earning 5% on an investment, you can have about $100,000 invested outside super. This is if you've got no employment income and pay no tax. So, there are always going to be opportunities to have investments outside super, and even for, people that have, retired now, you might still want to think about whether you're better off being outside super than inside super for some amount. So it's a good thing to remember, Peter, that the tax-free threshold.
I would bet you that there will be some families who will actually do deals as well. Someone like Alan gives the 147 to his daughter, who then puts in her non-concessional 500,000, and then they slip him $1,000 every week. Not that I'm recommending that, but I can see that going on. When you have crazy rules, people actually start thinking outside the square. I'm not recommending it, but that's why I bet you will happen.
I'm sure there'll be some people will take some initiative. But that brings me a good point, Peter, and I think it's something that's been missed in this debate. The strategy that many financial planners and others have been talking about now for a number of years with all these changes, and even if you go for Labor or Liberal policy, is you should be using every opportunity you can to try to even out your balance with your spouse. So if you've got a partner, see whether you can make the balance between the two as even as you can. There are two things you can do. Of course, you can legitimately, under the law, split your concessional contributions. That's the current up to $30,000 or $35,000 depending on your age, and you can split that with your spouse. You have to make an election to your super fund at the start of the following financial year to split last year's contributions. And if you are making a non-concessional contribution, well, look at whose name they go in. So, it's good for relationships, Peter. I mean, maybe the government's trying to... Let's think about our emotional well-being.
That's right. Those couples who do super together last forever. Here's an interesting question a lot of people have been asking me as well. If I am married, do we have the right to put $500,000 in each into a self-managed super fund? Or what if the husband's already done $700,000? Does it mean that the partner can only do $300,000?
It doesn't. So it's actually done on a per-name basis, per individual. So each limit applies to the individual inside the relationship. So if one party's got $700,000, that can stay. Yep. The other party can still do another $500,000. So you do have to think about who is making the contribution. If the contribution goes in one person's name, it's stuck forever on that person's name unless they do things like this concessional splitting, which you're allowed to do up to a limit. So you can't fiddle around with it once it goes in. So, but under the law, the family court law, this is give you a bit more confidence about relationship. In the event of a relationship breakup, super is divided 50% between the two partners.
I did come across a story, I think it was in The Guardian in Australia, that where a couple had broken up and the husband took the super, the wife got the house, but they'd already gone over the concessional cap. Now, she was saying, well, the only way I like it is non-concessional cap. So therefore, she said the only way I can build up my super now is by going to work and then making concessional contributions.
Yeah, well, we'll have to work out and see how that goes. I'm sure there'll be some traditional rules about that scenario, but the basic principle is it's 50% to each party. And so that's why, I think, as you say, from an optimisation strategy, the more that you can do to even the balance with your spouse, that's the best strategy you can actually employ in this at the moment.
Okay, just in the last 2 minutes, because this is a pretty controversial topic, Paul, what's your view on Labor's negative gearing policy?
I think I agree with all the property people. It will have an impact on the property market. It's immediate dislocation because the day it comes in, suddenly you've got a dropout of people that were buyers of second-hand property who'll just pull back from the market to see what happens.
Yep.
Right? And then you'll have some people who are forced to sell. So you can see that in that period until the market works its way through the system, you're going to have a drop in property prices. So you can argue that maybe on public policy grounds it maybe have some good benefits longer term, but in the sort of 12 to 18 months transition period as you go from one system to the other and suddenly you can't negatively gear second-hand properties, it's going to have some huge transitions.
Yeah, and it seems to me...
I think it's not going to impact the property market is crazy.
No, it seems to me that if I've got a house where investors want to buy and there's an auction coming up, there's going to be a lot less investors there bidding, which will either mean the price will rise at a slower rate or it could actually fall.
Yeah, so to think it's not going to cause any impact, Peter, I think it's just absolutely naive.
Okay, well, let's go to the new properties now. If new properties are negative gearable, if such a word exists, it means that investors might turn up there, but they also know that when they come to sell it, say in 5 or 10 years' time...
It's a second-hand property.
It's a second-hand property.
Where are the buyers? So, look, maybe it causes a bit of distortion in the new property market in the short term as people think that through. So I think I think... If you're thinking about your kids or something, or your own property, it's got to be bad for your own property in the short term. Longer term might even out a bit. I think the bit that's not clear is what it does to rents. Now, the economic argument is that if investors get a lower return, they'll require a higher rent, a higher return through income. And remember, property yields are really low at the moment. So people and their rental returns are down about 2 or 3% in some places. So renters are actually getting an absolute bargain if you think about it. And you compare that to the commercial property market where rents are more like about 6%, 6 or 7%. So you ask, why is it so different between the residential market and the commercial property market? I think negative gearing is one of the key reasons. So I think you can make a case that rents will have to go up in response. So I think people are going to be very careful about this. I think that maybe it's a pity the government didn't do a little bit to the market, backed away totally, but the transition issues on this are very difficult.
Yeah, and I always remember, Paul Keating thought it was a good idea in 85 and brought it back in 87, and I think it was the real world, the real market, had different developments compared to the theory of the experts who advised him in the first place. Paul, thanks for joining us. That's Paul Rickard from the Switzer Super Report. I hope we've answered a lot of your superannuation concerns. After the break, we'll take the pulse of property in Queensland with the CEO of the Real Estate Institute of Queensland.